Some of them, oh, was the recording not started?
It's okay. It's also live on Facebook, so there's a recording copy always there. This is just a Zoom specific copy, so we're all good, guys. This awesome
My
content
apologies.
is being recorded.
By the way, we have taken the previous speakers and posted them in our Facebook group.
Yes, so check out the Facebook group. I'll share the link here. Sorry about that. Go ahead, Daniel.
No problem. Thank you for starting it. So once you find a metro area that may or may not fit your qualifications on a macroeconomic and a demographic trend, if you think it has potential, you should start doing deep dives into particular areas, because as the people over at propertyradar.com like to say, all real estate investment is hyper local, meaning that the block that you're on as opposed to the block next to you might make a lot of difference in the way your property performs. And of course, knowing what the local HOA says, knowing what the city council says, the city planning commission, these are all critical to finding a good asset. And then focus on the entire city and surrounding areas and drill down into the MSAs. Finally, at the end, get your checklist out and score it. All right. I wanted to show this to you just because a lot of people haven't actually seen a metro area map of the United States, and it's kind of interesting just to look at it. And honestly, my main point here is just to emphasize that every single one of these green areas has different trends. And while macroeconomic trends might make a lot of them move together, many others are moving in the opposite direction. And from the point of view of a real estate investor, this is great. In fact, I love not having an efficient market. And I'll compare this to the stock market. The stock market is a much more efficient market, meaning that price discovery in the stock market is much more instantaneous than it is in real estate. In real estate, price discovery may take months or even years. And so if interest rates change, or if a major semiconductor manufacturer is putting a plant into an area, it could take years for those prices to reflect the overall demographic changes or economic changes. And that gives you a great way to go about doing your research and creating a business plan around your theory about what's going to happen in the area. With the stock market, back when I was a big stock market investor, and I have thankfully moved most of my portfolio into real estate now, and I don't feel the pressure to check the stock market as often as I used to. I'll go days and even weeks without checking it, and that's fine.
If I may interrupt you, we have a question on this topic. So Keisha is asking, so where would you buy a rental property on this map? That's a great question, but also a very loaded question. So I'll let you do the honors.
All right. Well, honestly, I think the rest of this talk is really about that. So I'll just go on. I'll start with the green areas. All right. Enough of this map. The main point here was to show you that you have a lot of choices, and there's a lot of research that goes into choosing a location. Every one of these areas has potentially different demographic and economic and local neighborhood and city neighborhood changes. As everybody knows, rent growth was abnormal last year. I'll use that word, abnormal. And a lot of it was caused by the pandemic and people's reaction to the pandemic. And that caused a lot of demographic changes. A lot of money was pumped into the economy by the Fed, and those things are starting to be reflected in overall prices as well. This is from Berkadia, I believe, and I'll actually touch on those later as paid sources of information. But this Berkadia map here shows the top 10 markets. Of course, hello to all of you down there in Chandler. Phoenix was #1 in rent growth last year. In 2020, I actually remember they were also #1 at 9.2%. But in 2021 and 2022, they're projecting 15.6% rent growth, which is too much. It's fast. But after that, other areas, Phoenix, Inland Empire, San Jose, Las Vegas, Tampa, Boise, Charlotte, Jacksonville, Florida, and Albuquerque. Now, just because this one statistic is going up very quickly doesn't necessarily mean that that is an ideal place to buy a property. There's a lot of other considerations that go into it. But I just wanted to show this to you up front as well.
So Daniel, another question for you on the previous slide. There is a question about why Albuquerque has such a high rent growth. Do you have any information on the?
You know, I do not invest in Albuquerque. And so I can only speak fairly generally on it. I imagine there's a fair amount of net, immigration coming in from California and surrounding areas that are very pricey, and people are looking to bring down the price of their rent, the price of their lifestyle. So we've of course seen a lot of uptick in Nevada and Arizona due to California and migration from California. But other than that, I don't know specifically why Albuquerque is up there.
I've heard similar things because I live in the Bay Area, and I know a lot of people who are moving there for the precisely same reason that you mentioned, Daniel, but it's all anecdotal versus data driven.
Yeah. Yeah.
And I think Zach has a question, which if that's okay, we can park for towards the end, because he's asking about our experience being like landlord of units and owners in the last couple of years. So that's maybe something we can talk through, all of us, towards the end.
Okay. So this is one thing that I like to go over with my investors, and that is talking about when you're putting together a business plan, how do you evaluate the various risks that are associated with the business plan? And how do those affect your decisions for into which markets you want to participate in? And so right here are the 5 areas that I tend to categorize multifamily investment risk into. And honestly, to any property that is managed by a manager. Could be an Airbnb, it could be office space, whatever it happens to be, mobile home parks. But your number one source of risk is going to be the people running the deal. And so as passive investors, it's really your job. The only thing you need to do, the reason why it's called passive, is because there's nothing else to do other than to choose the people and choose the deal. And so your number one concern should be the managers. And how experienced are they? How many units do they have in the area? How many Airbnbs do they run? How successful are they in achieving the returns that they said that they would achieve? So that's your number one area. Making sure that the managers are good managers and also honest managers, trustworthy managers. The second area is the market. Now, this is where it starts to become a little more interesting, because as a manager of properties, when I categorize risk, there are risks that are controllable and risks that are uncontrollable. And the market is one of those risks that is not controllable. Except for being able to identify demographic trends and economic trends and trying to find places that you believe will give your property a tailwind. So you can choose the best areas and the areas that have the most favorable conditions. But as a person who runs a syndication, you can't directly control the market, and you don't know what the market's going to do. So there is risk inherent with market conditions. Now, the third one is the one that I like, because that's the business plan. I can absolutely control the risk in the business plan. And in fact, putting together a good business plan should be really about mitigating risk. And that risk might come from the market or from the regulators or other areas. And so I get this question from investors a lot, what happens if the market tanks? And there's a lot that we could talk about there. But one of the things that I say is that, of course, you always try to choose the best market, but since you don't control the market, you have to compensate for that risk in other ways. So in other words, if you're a home flipper in Seattle, and currently the Seattle market is experiencing migration outwards, and so there's demographic trends that show that people are moving away from that area, even though prices are rising. And so what if prices start to go down because of the demographic trends. Well, in that particular case, if you've bought an ugly house in a decent neighborhood, then you have the ability to put money into that house. And the same with apartment. If you buy an apartment complex that needs renovation, you're going to buy it at a discount to the market price if it were fully operational and top of the market. So even if the market is going down, the money that you put into the property, making it better, will cause the value of the property to go up. And of course, in an ideal situation, you want to have a market that's going up and the property that's going up. But if you execute on your business plan well, you can compensate for market fluctuations. And so one of the entire goals of a syndicator is to maximize the amount of controllable risk, meaning make sure that your business plan is one that you can execute on. And if it is, that doesn't always have to, or it's not guaranteed to, I should say, but it can compensate for other areas that are experiencing more fluctuation. And so the business plan is an area that is completely controllable by the people that are running the deal. Fourth, the regulators. Now this can be controversial because people have opinions about regulators. Good, bad, indifferent, corrupt, not corrupt. They're all over the place. Regulators are all of those things. So one of the things that I look for is regulators that don't tend to change laws abruptly. And one of the reasons, and that can be controversial, it's not an absolute rule, but it does help because if I'm creating a 5-year cash flow projection, I want to make sure that the rules don't change in year 3, right? And then I can't promise, I can't deliver what I've promised. And so being able to know that the regulators are business friendly and are a tailwind as opposed to business unfriendly and a headwind is an important thing to understand and to research. Tends to be why I invest in the Midwest and the Southeast, although we are looking at Idaho and Colorado and Arizona and some other areas. All right, and then lastly, the property. I'm not going to talk too much about that because that's a completely other topic. Here in this talk, finding the real estate market is going to affect the market risk, the business plan, and the regulators. Any questions there?
Peter, do you feel okay with the response you got from Nisi? Or so Peter was asking about how do we vet managers, because managers was one of the risks that you stated, and Nisi already sort of shared with him information relating to vetting managers in the passive investment / syndication space. So if there are other scenarios, probably like I can share that when I picked my property manager for my rental, my single family home rental, I basically did reviews and I asked other people who've used that property management company that I knew. So while there's no public information, like I heavily relied on Google reviews because single family home property management is a little bit more widely used and easily available. And I think Nisi covered syndications. Are there other aspects, Daniel, that you want to touch on?
Honestly, right here, I don't want to touch on managers. I've got a lot of presentation and I'm going to go right to the market metro areas. Let's see. So ideal renters, if you are looking in an area such as New Albany, you really need to know, are these people renters from Columbus? What tends to be the employment that they have there? Are these blue collar workers who might be, working an hourly wage? And in which case, if you're looking at a C class or a B class property, that might be appropriate. Are they white collar workers who might be able to afford a little bit more? If you are doing distressed shopping malls or other types of assets, of course, the ideal renter profile is very important. So you need to keep that in mind when you're doing your research. All right, now for the case study. We're going to look at Columbus and New Albany, Ohio. And here is the City Hall or Village Hall, as they call it, of New Albany, Ohio. And first of all, I want to point you to 2 great resources. I can't underscore how great these are. These are wonderful websites, bestplaces.net and city-data.com. it's amazing how much information they have there, and it's very well organized. And so we will be using them for all of our upcoming data. And then next as well, if you are interested in getting a spreadsheet that will help you, let me just show the spreadsheet, I guess. Oh, not that one. Here's the spreadsheet. This spreadsheet we'll basically go through and go through the 4 or 5 areas that we're going to look at for initially qualifying an MSA. And that is population growth, income growth, home value growth, crime trends, and job growth. And based on these metrics, we'll either qualify the area or disqualify the area. And surprise alert, New Albany doesn't meet all these criteria. But if you're interested in getting that, getting this spreadsheet, you can download it here at bit.ly/GSC Good Samaritan Capital -NUM-markets.worksheet.
I'll share the link in the chat here shortly as well.
Oh, thank you, Misi.
Sure.
And can you guys see the Zoom bar that's sitting on my screen?
No.
Okay, Zoom's not showing it. That's good.
Yeah. Mm-hmm.
Okay. All right, first of all, macroeconomic trends, population growth. So the first criteria that I have is I usually look for at least, and these numbers can be debated, but I look for at least a 40% increase in population since the year 2000. Sometimes it's often good to look since the year 2010 as well, after the Great Recession, to see where things started over this decade as well. But if you go over to city-data.com, you'll easily be able to pull out these statistics here that the population in 2000 was, oh, I didn't actually put the number here. It was around 3,500 people or so. And now the current population is 10,933. So we have a 194.6% change in population. Now, you might say 10,000 people, that's not very big. Well, one thing that you have to keep in mind is that this is a suburb. And so we're not talking about the entire Columbus metro area here. We're focusing specifically on the suburb. And if you look at the entire population down here, Columbus, Ohio itself has only experienced a 26% rise in population since the year 2000. And you'll find that this sort of statistic is very common in the Midwest. In the Midwest, usually if you want to break it down investment-wise, you can think of the Midwest as a cash flow market. In this particular market, you want to look for deals. You're not going to find deals that appreciate a lot necessarily, or at least they're not common. You're going to find deals that cash flow, which are also not common, but they're there. And so the other types of markets are your hybrid markets. That would be like in Atlanta, where you have both cash flow and appreciation. And then your appreciation markets, which would be like New York, California, Washington, Portland. These are the markets where you're not going to find cash flow. Unfortunately, prices are so high that your mortgage is not going to cover your rent. However, you might find properties that go up in value. And one of the reasons why I do not like that is because if we go up here to our risks, if you have a property that's not cash flowing, but it's going up in value, you've got all your risk over here in bucket 2, the market. You've got your risk in an area that's not controllable. So the business plan can make or can break you, but it's not going to, if the market goes down suddenly, your business plan's not going to compensate in an appreciation area. All right. So it's kind of interesting to note the age distribution here as well. A notable lack of college age students in this area, and that's because Ohio State University is in Columbus, and it's a great university. And a lot of the kids in New Albany go down southeast to the university there. So there's a nearby university that's not in the city area, so you see this big dip in around your 20s. But then when you get back into your working age years, going from 20 all the way out to, even out here at 55 and 60, that's where the majority of the residents are. So this is very much a working age population. And it is kind of surprising to me that the retirement ages are as low as they are. I would imagine that over time, these will probably go up because a lot of these people will stay in place and just retire in that area. So over time, I would expect this to go up, but right now it's focused on the working age people. Next, macroeconomic trends, household income. Look for at least 30% increase in household income since 2002. And frankly, that's kind of kind of liberal in terms of, it's generous. The median household income in 2019, it's listed on city-data.com as over 200,000. That's not a precise number. I would want to dig into that a little bit more. I'm kind of surprised. Usually they do give a precise number, but they do mention that in 2000, income was 102,180 on average. And so you've seen, 100% increase in the last 19 years, and maybe even more in the last 2 years. So this definitely checks the box for household income. It's interesting that Ohio, the average income in Columbus, I'm sorry, in Ohio generally is 58,000. So you can see here the income distribution. New Albany is a wealthy community. This is a very well-to-do community where people have great jobs and are making high salaries. Here's an income distribution map. So you'll see the lower southwest corner here is the wealthiest area currently. When we get to the business plan map, you'll notice that most of the area up here in the north and the east is business. And for those of you who are curious where the Intel plant is planned to be, it's going to be right up in this area in the northeast corner. All right, criteria number 3, and oh look, it's covering my title. Look for at least 40% increase in median home price since 2000. Now you can include the last 2 years or you can remove them. Personally, I think they tend to skew the data quite a bit, and so it's good to look at them separately as well. But here's the median household income. Oh, that should be on the previous slide. Okay, distribution of house value. The distribution of house value here is still the majority of houses in this area. This is Columbus, not New Albany, are 400,000 or less. And actually, I guess I don't have the number here, but just from reading on city-data.com, houses in the New Albany area tend to be anywhere from, there are a lot of very expensive houses in the area, multi-million, several $7 million places, but the average house is around $400,000 to $700,000. You can see here a uptick in home sales, particularly during the pandemic, particularly during the last years here. And then over here, you can also see that prices of these have been going up in the area as well. So here's a little bit of a comparison in between Albany and Columbus. And here's a map of Columbus in general. New Albany is right up here in this area. So you're seeing a lot of green as you approach New Albany. But just to give you a picture of Columbus, the upper Arlington area tends to be a better part of town and in this area. And down in these areas, you have some of the poorer parts of town. So it's always good to know your demographics in that case. The next trend, violent crime. Actually, I want to hit this over here. The median home value in New Albany in 2019 was $579,000, and in the year 2000 it was $465,000. So that is a price appreciation of 25% or so. So it's not particularly good, and in fact, it does not meet the criteria number 3 here for a 40% increase in median home value. And that, is something to note and to keep in mind. Mainly that's because this is an area where home appreciation, the Midwest in general, isn't as strong as in a lot of other areas. So when you're formulating your business plan, you want to make sure that you're finding properties that can cash flow or where you could force value by doing renovations, force value increases. And then lastly, or at least the last of the 4 criteria here is the crime rate. What's the violent crime rate? What's the property crime rate? And here we have the New Albany versus Ohio versus the United States. You'll see that New Albany is very low in terms of violent crime rate. And Ohio in general, it trends lower than the rest of the United States. I'm kind of curious what happened here in 2001 and 2002. Both the property crime and the violent crime spiked. I haven't looked into why that is, but it's interesting to see it came up and then went down significantly and is below the national and the state trends. So this would get a check mark. I usually tend.
We
Yeah.
have a question. It's about how we are coming up with the criteria. Like, how do we say 40%? How are we coming up with the criteria in itself?
Honestly, it comes from just looking at a lot of different metro areas and setting your bar at about where you think it should be. It's based on personal experience, and there's a lot of room to talk about different ways to qualify an MSA. The rules that I'm giving here are not absolute rules. They're just rules that have heuristics that have been developed. So you can absolutely change these. What I'd recommend is, go get the data for 50 MSAs and put them into a spreadsheet and see which ones are good on all 4, which have 3 and are, miss on 1. But in general, just looking through data and sorting it, you can come up with rules of thumbs. All right, crime map. This is an interesting map here, and usually maps like this might scare you away from an area. I was actually just on the phone an hour ago with an investor friend of mine from Dayton, Ohio, which is about an hour away from here. And he said that he only considers 3 areas of Columbus to be perhaps what you'd call a high crime area. And this map, of course, shows everywhere the crime is a little more elevated than the surrounding areas, but that's normal for a city. And so it's interesting to see these. This is New Albany over here. All right, business development. So when you're looking at whether a particular metro can support your ideal renter, you want to know exactly what sort of businesses and large employers there are there. What is the joblessness rate, and what types of breakdowns you have in terms of the sectors that are represented there. It's always, of course, best to have a diversity of sectors being represented there. And just to give you an for example, why it's good to have that. I was looking at a property in Memphis, Tennessee, and it was on the southwest side of town. It was slightly outside of the town, and it was decent. It was a good area. I underwrote the property. It had really pretty good numbers. And then as I started digging into it, I realized and I figured out that every single person that was living there was employed at a casino that was 1 mile down the road. And so if that casino, if the city passed a law which outlawed gambling, boom, the investment's dead. And so that's an example of not having a diversity of economic choices for your renters. So of course it's best to have a wide diversity here. That way, if healthcare or finance or any one of these takes a nosedive, then the other areas can of course support you. The top employers here, New Albany is the worldwide headquarters of Abercrombie and Fitch. They also have the Bob Evans Farm Group, which was recently located in Columbus and has moved up to New Albany because of, and we'll get to this soon, the tax incentives that have been offered by the city of New Albany. A lot of people are employed in government and educational jobs. The school district is the number 3 employer in this area. And then after that, New Albany and Columbus, actually, I don't remember if this statistic was for Columbus or New Albany, probably Columbus as a whole, has over 70 insurance companies that are represented in this area. So insurance is a big employer in the area. And then of course, power and energy is another huge employer in this area. Financial services, also very big. People from a profession point of view are in professional and technical services, management and executive services, finance and insurance, and then healthcare, clothing, education, construction, and administrative and waste management services. So those are your top sectors in this area. This was fascinating to find. So I went to the New Albany the City Council business planning website, and I found this map here. This is their planning map for the business atmosphere in New Albany. One of the things I noticed here, just for reference, the Intel plant will be up here kind of off the map to the upper right. But notice here that Amazon Web Services, and one of your options over there, east, I believe it's east number 2, is Ohio. And this is where those data services are being actually executed and run. So Amazon has a data center here. Facebook has got a huge data center here. They actually announced in 2017 that they would be moving a data center here, and they have done that. Google also has a data center here. So you can see that this whole area is very tech heavy and is becoming a tech center, at least from a data center point of view. And that's interesting. The AEP here is the power station and the power company in the area. So they have several installations around. And then Aetna, health insurance and ETH and different clothing manufacturers are all represented in this area. So this is the build out plan that you'll find in New Albany's business development group, their city commission for doing business development. And it's interesting to see what they have planned here. Also, if you go there, you'll notice that New Albany is extremely pro-business. They are actively trying to get businesses to move there so that they can increase the wages and the standard of living in the area. All right, if you look on the city planning site, you'll find a number of New Albany tax incentives and programs for attracting businesses. And the number one thing that they had on their website when you clicked on local services was the community investment area real property tax abatement. And when I looked at this, I was not surprised that there were so many data centers in that area. It says exemptions are available for real property tax abatement of up to 100% of your tax for up to 15 consecutive years. That's a great incentive. And that there's a lot of qualifications for that, but basically the qualifications, I believe you had to put at least $1 million into your installation, which for any of those is a drop in the bucket. And there were a series of other qualifications you had to meet in terms of green energy usage and environmental standards. But in general, businesses that were moving to New Albany could count on getting tax abatements for up to 15 years in this area. So no wonder they have large businesses going into that area. Job creation incentives. Now, if you meet certain standards that the city sets in terms of the, I believe, actually, I didn't dive too much into this, but basically, if you meet other certain standards, and green energy was one of these, they can reduce the amount of payroll taxes that you have there as well. So the job creation incentive agreement does that. They have a green building incentive program. So New Albany's green building incentive program entitles companies to a reduction of up to 25% on building permit fees for eligible projects that advance sustainable development goals. And then lastly here, one of the city's biggest programs, the City Tax Increment Financing Program, locks in the taxable value of real property in place at the time the city authorizes the TIF. A proportion of the property taxes on the new value created by the investment are redirected to a separate fund that can be used to pay for improvements on land, public infrastructure, other purposes in the investment. So they have, and this was just all that I could fit onto one slide. They had a dozen other programs as well. And so you can see that this is a very tax-friendly area. And that's why, a lot of companies have announced, and I just put the tech companies here because I know that's what this audience is. The tech companies are moving to this area, most likely because of the rebates they're getting, and they're bringing jobs, they're causing wages to rise in the area. I've noticed also that taxes in the area, if you're living there, property taxes are fairly high. The city is actually in negotiations right now with the Columbus Library to put an arm of Columbus Library up in New Albany. So they're building out a library. They have a lot of public recreational areas. They have a bicycling area that's outdoors called the Velo Loop. They're trendy and they like to name things after French words. They also have an outdoor amphitheater. They've got a lot of outdoor park areas. They've got an outdoor market square. It's a very well-off area.
Nice, Daniel. As we just wanted to remind that we have 10 minutes left. Yep.
All right. So I'm gonna quickly round this off by saying, once you've made it all the way through your free data sources, if you're convinced that this is an area that you want to go into and invest in, now it's time to pay for your data sources. So there's a variety of places that you can do that with, and you can find really great information. Some of the interesting information over here, particularly this one, supply and demand. So when you're looking at multifamily properties, you want to know how much new construction is there in the area, how many people are selling older construction, and what is the net absorption rate of that. So how many people are renting new property units that are coming onto the market. And what we're seeing here is a similar trend to most of the country right now, although it's not as bad as most of the country. Most of the country has severe supply shortages of real estate. You know, housing is in demand and prices are going up. And you're seeing the same trends over here in New Albany. But so what that's going to cause is that there's going to be a high amount of demand for your units, which means that you will, first of all, most likely have good occupancy. And occupancy, if I remember right, the occupancy in this area was around 97%. So, which it's high everywhere in the U.S. right now. 97% isn't too unusual. And actually, it can be a problem if you're rehabbing, because you can't rehab a unit when somebody's living in it. And so to be able to turn and rehab units, you need to have a certain amount of vacancy in order to do that. And oftentimes that sweet spot's 92, 93% of your units. But we're going to see here strong demand, or strong demand for the small amount of supply that's there. The other thing that this will allow you to do is it also means that rents are going up, and that, you know, there's a lot of opinions about it. Rents are getting expensive. There's no doubt about that. And so rents will probably continue to be expensive simply because there's such a supply shortage right now. Here we can also see the value of the sales of multifamily properties have been gradually increasing over the last several years. And the cap rate, which is inverse to the sales price, is going down at about the same rate. All right. Here are some great publications that are free, actually, but they're from the major brokerages. So over here we have Berkadia. Berkadia's reports are, all of these reports are great here. CBRE, RCL, CO. I don't use them as much, but I looked through this report and it was really good. Walker and Dunlap, and then of course Marcus and Millichap. Most of these brokerages actually offer these reports for free. You just need to go and, you know, give your contact information and they'll email it to you. But these have really good reports, such as this for Columbus, Ohio. This came from Berkadia's report. And you can just get a lot of good, high quality data about an area that you're looking into. And you can read about the macroeconomic trends in you know, a lot of these reports. And so check out your paid sources and the free sources that are available at these large brokerages. All right, so quickly, how did New Albany do in our criteria? Looking for at least a 40% increase in population since 2000, check. Looking for at least a 30% increase in household income since 2000, triple check. Looking for at least a 40% increase in median home price since 2000. Now, their home price only appreciated 25% over this area, so X marks the square. Looking for a violent crime rate that is under the national average and trending downwards, check. So it did fairly well. So when you're looking at this, This doesn't mean that you necessarily disqualify an area. What this means is you reevaluate your business plan to take into account that you may see a lower amount of appreciation in this area. So if you are investing in this area, you want to make sure that you can invest for cash flow. That's true in a lot of the Midwest. Now, the Midwest is benefiting from a nationwide rise in property prices and migration from areas where property has already appreciated a lot. But it's still not dramatic, certainly not compared to Florida or Texas or other areas that are seeing high amounts of net migration. So criteria 3 here failed, and it just means that you need to keep that in mind when you're creating your business plan. All right, that's the end of my presentation. I do want to say, though, that starting in 2 weeks, I am offering, and for those of you who started coming to the Passive Syndication Club, that club originally was meant to be basically community driven. We'd propose a property and we just talk through it. But I've realized it's difficult to get people to propose properties. And so there's been very few meetings of it. So instead we're reorganizing, and I'm actually going to do a 12-week course on evaluating real estate syndication and fund investments. And this will meet once a week for 12 weeks. And we're going to go over creative relations and brokers, underwriting, due diligence, legal partnerships and strategies, building a network, building a property acquisition and management team, investor relations, exit strategies, the Security Exchange Commission and their rules, and then transitioning from active to passive investors. And I am going to charge a fee for this particular one. I want to find people that are actively involved, and so it'll be a nominal fee, but there'll be a fee for this because I want people that come to actually be committed to it. And so if you're interested in that, you can email me at daniel@goodsamaritancapital.com, and we can go to questions in the last 3 minutes. What are the best questions you have there? And my apologies, we're not going to get to all of them.
I think you have only one question, Daniel. What time will that be? Whatever the session.
What time will the session be? Probably towards the end of the day. It depends on when people can make it. I'll do a survey of the people that are interested, but 4 o'clock-ish towards the end of the day, Pacific time.
Okay. The other question from Juan is, will there be a course in the future to multi-unit acquisition for beginners?
That's what this is. Yeah, that's what this is. So we're going to look at it from the passive investor's point of view, but I'm an active investor, so we'll have lots of that thrown in as well. But this is really from the very basics of the business model. Probably took me a solid year to learn myself before I felt comfortable doing anything. And so I want to condense that down to 12 weeks, and we'll start at 0.
So do you have a deal in New Albany? Is the almost last question, or at least
we are
you going to invest?
Yeah. We're actively looking at that area. Like I said, I was talking to a boots on the ground person just an hour ago, and we have contacted Newmark. Is the brokerage which apparently dominates about 85% of the large commercial property transactions in Columbus, and we have a number of properties that we're going through. Just to give you, and most of the properties do not meet our investor criteria. The first property we underwrote looked like a great property. It's a very pretty property, but it only underwrote at a 6% return, and we usually try to hit 15% return or better. So a lot of them are not going to meet that criteria, and we're going through and actively underwriting in the area. Any other questions?
Can you have a tax saving strategies for real estate investors? It looks like there's a confusion.
You know what? That's a good thing to add onto the course, tax savings. But in general, just to be really quick about it, real estate is wonderful because it's passive income and you get depreciation. It's long-term. You can cash flow properties and you can benefit from cost segregation and bonus depreciation. Bonus depreciation's being phased out starting next year, but there's a lot of good ways to be in a good tax position with real estate.
Daniel, lastly, can you tell us for Good Samaritan Capital, like what is usually the minimum investment that you're looking for?
It varies per property. 50,000 is pretty common. 50 and 75. We're going to be closing our 11th syndication on Valentine's Day this year. 120 units in Des Moines, and all 11 of those have either been 50,000 or 75.
Congratulations, Daniel. That's a great way to celebrate Valentine's Day. Your love for real estate. Oh,
Don't let my wife hear that.
On that happy note, I think we are at the top of the hour. So Kimberly's asking about slides. We plan to share them on our Facebook group, right?
Yeah, I'll share them on the Facebook group.
Yeah.
Also, Daniel will need the link, Excel link, to be a shareable one instead of requesting access. Someone asked.
Oh, okay. Yeah, you just request access and I'll grant it.
Oh, okay.
Sounds
All right then.
All right. If everyone wants to go off of mute and thank our beloved Daniel, I think this was a good session. Oh, what is the FP group?
Thanks, Daniel.
Oh,
Thanks,
Daniel. As always.
Thank you.
Thanks, Daniel. Thank you, Daniel.
bye-bye. Thank you, everybody.
Thank you.
And we could probably end the recording there.
And I
Yeah,
got
we're also probably gonna create a group on LinkedIn. When we have that, we'll let you guys know. For those that's not on Facebook.
It should be surprised. I ran into